Thank you, Gavin. Members and guests, Mike Ferraro was appointed Chief Executive Officer of Alumina Limited 2.5 years ago. Prior to this, he was a non-executive director for over 3 years. He is also a non-executive director of Alcoa of Australia Limited and Hello World Travel Limited. Mike has a long and distinguished career in law and investment banking, including senior leadership roles as Global Head of Corporate at Herbert Smith Freehills, and before that as Chief Legal Counsel at BHP. Mike is a proud Melburnian and a member of a proudly Italian family who settled here in the late 1950s. He grew up in Melbourne's northern suburbs, was a pretty good young soccer player, and for a while thought about physical education as a career. But he says he didn't have the patience for teaching, and in any case, once his family was aware of his academic prowess, he was strongly encouraged to be a doctor or a lawyer. So Mike studied law at Melbourne University, took out an honours degree, and for his first role joined Arthur Robinson's, now Allen's, followed by 5 years in investment banking. He subsequently joined Freehills as a senior lawyer in the corporate team in Melbourne and made a great contribution to the success of that team as a lawyer and partner before taking the leadership roles I referred to earlier. Mike's passion for sport has remained, but broadened from soccer, the beautiful game, to AFL, the great Australian game. Growing up in Melbourne's north, not surprisingly, he's a North Melbourne tragic. Mike is both a professional and a leader. One of his specialties is his profession and corporate life is to focus on underperforming parts of his teams and to instill higher performance with the right culture and to bring a team closer to the needs of the business. Mike is a strong believer in not only the right strategy, but also the ability to implement. It was these attributes which have enabled Mike to succeed in many organisations and led to his appointment as CEO at Alumina Limited. Members and guests, please welcome Mike Ferraro to the Melbourne Mining Club.
It's a sea of yellow. It's amazing to see. It's a bit daunting having such a large crowd to present to, but I hope I can do your time justice. Welcome, ladies and gentlemen, co-patrons and special guests. I would also like to recognise Hugh Morgan for his contribution to the company we now know as Alumina Limited. Today I'm going to take you through a small journey, the history of our company and where it is today. But before I do that, I would like to acknowledge the Wurundjeri tribe people, the traditional custodians of the land in which we meet today. We pay our respects to their elders, past, present and emerging. Can I say how much I applaud the initiative of the club to highlight the critical importance of safety in our industry today. Managing safety in complex mining and manufacturing environments requires strong systems as well as a focused safety culture committed to continuous improvement. It wasn't always the case. When I was a young man, in fact a teenager, I worked in a few places. 2 places in particular included a foundry and a packaging factory that made timber crates where motor car engines which were manufactured in Australia were exported. So I was a young lad, arrived, told what my job was, working with equipment, electric saws, nail guns and so forth, electric grinders to grind down metal. There was no safety wear, there were no steel cap boots, there was no training, and if somebody was injured, it was usually their fault. That was the way it was looked on. And I really didn't know better at that time. I sort of worked out that it probably wasn't right. I'm glad to say we've come a long way since then, not only in this industry, but in others. We and our joint venture partner and operator of our assets, Alcoa, have invested substantial resources over several decades to create the right safety environment, ensuring that robust controls are in place, supported by effective audit processes. So who are we? Let me start with a brief description of who we are and what we do. Alumina Limited has a 40% share in the Alcoa World Alumina and Chemical Joint Venture, known as AWAC. It's a slide there showing a history of where we are today. AWAC was formed 25 years ago, next month, to combine Western Mining's Australian bauxite and alumina assets with Alcoa's worldwide upstream assets as a platform to build a global business. Our 60% operating partner is Alcoa Corporation. The market currently values our share of the joint venture at 6.5 billion Australian dollars. The crown jewels of AWAC are our magnificent bauxite mining and alumina refining assets built on the extensive bauxite resources of the Darling Ranges in Western Australia. They were originally identified by Western Mining in 1957, when its far-sighted then chairman, Sir Lindsay Clark, initiated a deliberate search. The Darling Ranges deposits were known about but seriously underestimated until Western Mining saw the potential in them. They had significantly lower alumina content than deposits mined at the time, as low as 30% compared to the more standard deposits of 40% or more. In the late 1950s, Western Mining's legendary geologist, Roy Woodall, was asked to have a closer look at some samples. He found that treating the Darling Ranges bauxite at lower temperatures than other deposits would provide both energy savings that offset the lower alumina content and also require less caustic soda to remove the reactive silica. With this exclusive knowledge, kept extremely tight, Western Mining quietly pegged an enormous chunk of the Darling Ranges, 16,000 square kilometres in fact, just to be safe. The late Sir Avi Parvo, assisted by Sir Lindsay Clark, to give shape to Alcoa of Australia. Other Collins House companies were brought in, Broken Hill South and North Broken Hill, and then the Aluminium Company of America, now Alcoa, joined to bring its technology, its needs as the head customer, and its very large balance sheet. At the same time, Woodside and its associates discovered the Northwest Shelf gas reserves off the coast of Pilbara. Alcoa of Australia was a foundation customer, taking 25% of the shelf's output. So, low-cost gas was combined with low-cost bauxite, and one of Australia's greatest value-adding enterprises was established. It's hard to imagine how this could happen now, but it took 27 years for our joint venture in Australia to pay a dividend as loans were paid off and refineries and smelters built. Western Mining finally began to reap the benefits in the late 1980s. It's fair to say that the real gems are always our Western Australian mining and refining assets. They remain the cornerstone of the modern AWAC joint venture, which in 2018 generated EBITDA of $2.6 billion US dollars on total revenue of $6.7 billion US dollars. It's now 58 years since Alcoa of Australia was formed to develop the Darling Range bauxite deposits, and we can't underestimate the vision and determination of that pioneering generation. And now to AWAC, our joint venture. The joint venture was created to align the interests of Alcoa of Australia and Alcoa Inc.'s non-Australian global upstream portfolio. AWAC produces over 12 million tonnes of alumina per year, or about 10% of global smelter-grade alumina production and 21% of Western world production. The core WA assets comprise 2 bauxite mines and 3 alumina refineries, which produce over 9 million tonnes of alumina per annum. Nearly 60 years after they commenced operations, these remain outstanding, low-cost, long-life assets with decades of contribution ahead of them. Other assets that AWAC operates are the long-life Juruti mine and the Alumar refinery in Brazil, which was expanded in the mid-2000s, and AWAC's share of alumina production is now 1.5 million tonnes per annum. The San Ciprian refinery in Spain, which produces 1.6 million tonnes of alumina per annum, both smelter grade and chemical grade. The Portland Smelter in Victoria, which has an agreement in place to operate at least until the middle of 2021. Going forward, Portland requires a low-cost and reliable energy solution. AWAC also has an equity interest in the Ma'aden joint venture and alumina joint venture in Saudi Arabia, the CBG mine in Guinea and the MRN mine in Brazil. CBG was the first major bauxite mine in Guinea and has recently been expanded. In 2018, AWAC's average alumina cash cost of $226 per tonne put us in the lowest cost quartile globally, and this year it will be lower. In the third quarter, the cash cost was $203 per tonne. The success of the AWAC business over many decades has endowed AWAC with great advantages. We enjoy a strong position in the third-party global alumina market, on top of the 30% of our output that goes into the Alcoa system. AWAC's customer relationships are close and long-standing. Focusing on Australia, there's a high-quality workforce and stable. We employ around 4,250 people, both in Western Australia and Victoria. We also have a consistent record of contributing. For instance, Alcoa of Australia is one of Australia's highest taxpayers, and it paid more than 690 million Australian dollars in state, federal and local government taxes and royalties for the 2018 year. Its tax rate is 30%, which in turn enables our company to pay fully franked dividends. I'll now turn to Alumina Limited. We are the closest thing in the world to a listed pure-play alumina company. There's nothing like it. We describe ourselves as one of a kind. Compared to our industry peers, we are almost fully focused on the refining the intermediate alumina product in the aluminium supply chain. As a result, when the cycle is running in favour of our product, the company has a remarkable ability to generate shareholder returns. Our average annual dividend yield over the last 3 financial years was 9.5%, and that doesn't include franking. The quality of our assets also ensures we do relatively well when the cycle is running against us. In 2016, at the worst of the cycle, in the last 10 years, AWAC was one of the few Western producers to break even. It has been a pretty positive picture in recent years, but it hasn't always been like that. Let's go back to the demerger of Western Mining in 2002. Alumina Limited is the continuing company. That is, we are in fact Western Mining renamed, and we retain WMC's 40% stake in AWAC. Our first chairman was Western Mining's long-standing finance director, Don Morley. Don recently passed away, and we acknowledge a contribution that he made to our company. At inception, Alumina Limited had a much lower market capitalisation than now and higher debt of around 500 million Australian dollars. In contrast, our current net debt is 65 million US dollars and our balance sheet is very strong. Our joint venture arrangements originally had limited rights. The company was very much dwarfed by Alcoa, 20 times our market size. At the time of Alumina's demerger, it was thought our future would be limited and that shortly and very soon Alcoa would come and take us over. 17 years later, we are still here. And now we have a larger market cap than our joint venture partner. For some years, the company's role was to play the good soldier. We contributed to the growth of AWAC when required to do so, and we provided a highly efficient platform for our shareholders to benefit directly from the quality of the AWAC portfolio. In 2013, the respected Chinese group CITIC, one of AWAC's partners in the Portland Smelter, took a placement of just over 13% in Alumina Limited and now holds 19.1%. This gave us a welcome addition to the capability of our board and strengthened our balance sheet considerably. Nonetheless, as time moved on, Alumina Limited seemed to be consigned to the waiting room for developments to produce some value crystallising event. As I'll explain shortly, events did turn in our favour. This was prefaced by the explosive growth in China that turned our world upside down and produced the disruption that ultimately created new opportunities. The scale and speed of China's movement into light metals almost defies belief. China's alumina capacity grew at around 19% compound per year from 2005 to 2018, reaching around 85 million tonnes per year at the end of last year. At the turn of the century, China produced 8% of the world's alumina. By 2018, this had grown to a staggering 55%. The growth in Chinese alumina production was driven by 4 factors: growing demand for aluminium smelting, China's ability to build refineries quickly by using a standard modular design at a third of the cost of building Western refineries, the availability of low-cost bauxite sourced domestically in China and from Indonesia and Australia, and stimulus package funding during and after the GFC. But the result of this growth was the disappearance of China as a sizable alumina importer, which triggered significant price impacts outside of China. Refiners in the West were forced to make hard decisions to curtail high-cost alumina production. AWAC itself sold a refinery in Jamaica, curtailed the Point Comfort refinery in Texas, closed Sorelco in Suriname, and the Point Henry Smelter and Anglesey Power Station in Victoria were also closed. In this way, AWAC came through the cycle with a smaller but more profitable portfolio and lower average production costs. At the bottom of the recent cycle, a number of positive factors emerged at once, which enabled us to benefit considerably. First, there was the rebalancing of the market. Second, there was the positive impact of greater emphasis on environmental priorities within China. Third, there was a latent impact of market pricing for alumina, which had been adopted some years earlier. Finally, the historic renegotiation of our joint venture agreement with Alcoa, triggered by the demerger of Alcoa's upstream and downstream businesses. The return of a balanced market in 2017 owed something to the closures which took place in the West during the worst of the cycle, but also other factors within China. Importantly, China's bauxite reserves are depleting, and its alumina production costs have risen, making Shanxi province in China the global marginal cost producer. We don't expect China to be an alumina exporter, except at times of high Western world prices. Secondly, complementing these forces is China's increasing tightening of its environmental standards. Refineries now face issues storing residue. They must comply with higher production standards, raising costs over time. Some refineries continue to face winter curtailments to manage air quality. In 5 years, we expect 75% of China's bauxite needs to be imported. Thirdly, we now have a dedicated pricing mechanism for alumina. API, that is the Alumina Price Index. It has produced a revolution in our industry, similar to iron ore trading and the impact in that industry. Historically, alumina was priced as a percentage of LME aluminium. This worked against refineries because aluminium prices did not reflect alumina markets and costs, especially under long-term contracts. Alumina's physical characteristics cause it to deteriorate, if not bagged or consumed by smelters within months. So supply disruptions can have immediate market impacts. We saw this last year with a potential curtailment of Alunorte in Brazil, the world's largest refinery outside China, producing 11% of Western supply. API prices in 2018 ended up averaging 1/3 higher than in the previous year, largely due to regulators halving production at Alunorte until the plant proved it was compliant with environmental standards. Finally, a further positive act for us was the renegotiation of our joint venture with Alcoa in late 2016. Again, the trigger was the disruption caused by China's explosive growth, not just in alumina, but also in global aluminium production, much of which came in low on the operating cost curve. This seriously and negatively impacted the upstream aluminium supply chain in the West, especially in smelting. Activist shareholders in the US argued for the separation of Alcoa's upstream and downstream businesses, which were expected to have different trading multiples. We saw the need to renegotiate our joint venture with Alcoa because the proposed demerger of Alcoa effectively replaced our partner in AWAC with a new one. To address that, we sought fundamental changes to our position in AWAC. Broadly, we gained a greater say in AWAC's strategy and in particular approval rights over significant investment decisions, more certainty and greater control over cash flows, and the removal of takeover impediments for industry acquirers, including the creation of offtake rights for an acquirer of the company. Our shareholders backed us all the way. The AFR called us the mouse that roared. We thought that description was a little uncharitable, although we liked the idea of our roar being heard. It was clearly an improvement over some previous descriptions of the company. Our experience since the renegotiation has met our expectations. We have clear sight into AWAC operations and performance. We are contributing to the operations and strategy of the joint venture, and importantly, we know our investors value our company not only for the quality of AWAC's assets, but also for the certainty of Alumina's rights to AWAC's cash flows. It's worth now turning to the outlook for our commodity and its principal use, the smelting of aluminium. With the current downturn in manufacturing activity and concern over trade wars, demand for primary aluminium is stalling. The alumina market is expected to remain in surplus this year and likely next. In the medium term, demand growth is expected to return. By end-use sectors, it's predicted to be fairly even, led by consumer durables, electrical and transport sectors. Construction growth is also expected to resume. The growth drivers expected in developed economies include personal consumption, as stronger aluminium concerns promote lightweighting in transport to reduce carbon emissions, and aluminium replacing plastic and glass in packaging. To give you an example, I was in the US in Chicago a few months ago. Mineral water at the conference was served in bottles shaped like this but made of aluminium. In developing economies such as India, there are growing demands for large volumes of aluminium for infrastructure and construction. The longer-term prognosis for alumina and aluminium demand is positive. For AWAC, this means, like our far-sighted forebearers, we are considering the long term again and assessing the timing and nature of new growth projects in alumina in Western Australia. Our Tier 1 assets give us attractive brownfield options. I will now turn to sustainability, which provides both risks and opportunities. Better environmental, health and safety management are required to meet higher standards demanded by local communities and by downstream consumers, society in general, who seek more responsibly sourced supply chains. This will benefit producers who are already acting responsibly. Recent tailing dams failures will add costs and time to bauxite tailings dams and residue disposal areas, and also favour those who do not need to wash bauxite or who use press filtration, like AWAC in some of its operations. AWAC's CO2 emissions on an absolute and intensity basis have been progressively decreasing off the back of asset sales, plant closures and curtailments of higher emitting facilities. Already our refineries have one of the lowest CO2 emissions intensity in the industry. To support our joint venture, we will aim towards establishing greenhouse gas targets for our refineries, identify and assess the climate risk changes, and undertake scenario analysis, and work towards aligning disclosures with the recommendation of the Task Force on Climate-Related Financial Disclosure. Finally, to the outlook for Alumina Limited. As I've pointed out, with our unique focus on the upstream and most profitable part of the aluminium production chain, Alumina Limited is one of a kind. This is reinforced by our leading exposure to API pricing, which sees the company financially impacted by alumina supply and demand changes more than any other non-Chinese company. Our cash flows are transparent, our balance sheet is strong. Investors have a better view on what dividend to expect, and the company has been attractive to yield investors. The quality of AWAC's assets give Alumina Limited the opportunities to benefit from Tier 1 asset growth opportunities. I began this address by recalling the contributions of the greats in our industry and how they built for the very long term and contributed so positively to Australia's economic development story. Alumina Limited is very much their modern heir. We successfully managed our way through the shocks caused by the rise of the Chinese industry, and we have been well positioned to benefit from the changes to the alumina market. I also believe this enterprise, built from the fabulous red soil of the Darling Ranges, has more successful decades ahead of it. Thank you.
Thanks, Mike. Members, guests, we go to traditional area of questions from the floor. So we have Sam Street and Richard Shoddy. Who's got the first one? Richard, have you got the first one? No, Sam Street over here. Please stand and identify yourself.
Hi, My name is Shane McNeice. You didn't really say how much was left in the Darling Ranges.
No, that's a good question, Shane. There is a lot left in the Darling Ranges. Many decades. We haven't disclosed exactly the resource, but our licence to operate runs, I think, to 2045, and there are also options for renewal. But there are significant bauxite resources in the Darling Ranges.
Okay. Sam?
Mike, I'm Rowan Callick. Thanks for the great presentation. About China, I'd like to get your reading on the medium-term outlook, perhaps a little bit guided by having CITIC, that well-respected institution, as an important part of the organisation. In demand terms, what impact do you think the slowdown is the GDP production slowdown going to have? And in output terms, what's the likely result of those changed pollution requirements? Could it in fact mean that we'll see importation of more alumina from overseas as well as bauxite? So both the demand and production ends for
Sure.
China. Thanks.
So demand has slowed in China, and this year it'll have a surplus of alumina and potentially into the next year. And that's driven by a few things, including more alumina supply coming on stream, not being matched by aluminium capacity being built, but that is just a timing mismatch. There is a significant amount of aluminium smelting capacity that's on the drawing board to be built, particularly along coastal areas, to bring in bauxite from overseas. So the demand will be soft. That's certainly been impacted by the trade wars and global slowdown, and with excess production there will be a surplus, but over time, certainly probably after the end of next year, we expect that to balance out, and we see the construction sector, particularly in housing, in China coming back, and also electric vehicle production, which uses more aluminium, both in China and the rest of the world, coming back to rebalance the demand and supply equation. So short term, stalled, longer term, positive.
Good afternoon. Ed Cooney from EMR Capital. First of all, thank you, Mike, for the presentation. My question relates to supply and demand, or more forecast growth. You had a slide in there showing over the medium term future growth, and I just wanted to understand what sort of consideration you had, or if you perceive much risk around substitution of perhaps composite materials in the transport industry, and what they may do to future demand for alumina. Thank you.
Thanks for that question. On the transportation demand going forward, the outlook is actually positive for us, as for aluminium. As more electric vehicles are produced, they use up a higher content of aluminium, and I think it moves from about the low teens to up to 25%. So I think the prognosis is very good for aluminium in electric vehicles. It doesn't appear to be any alternative metal that would act in substitution or places that at risk. So that hopefully answers your second question. In respect of your first question, I think you were asking about our growth opportunities and the risks associated with that. With the growing production of alumina in China and also aluminium, What is important to us is to remain one of the lowest cost producers. As I said in my presentation, our current cost of production is about $203 per tonne, compared to an average in China of just over 300, around 310, $315 a tonne. So as long as we can maintain a low cost of production, we're extraordinarily well placed regardless of any cycle and the ups and downs of that cycle. So that gives us some confidence to look at expanding our capability in Western Australia, to look at growing production at 2 of our refineries over the medium term. Now, we obviously need to take into account global supply and demand, but you don't build these additions to our existing facilities overnight. You're talking a 2 or 3 year time frame. So we need to ensure that we're well placed for when the market turns around, which we hope it will post 2021, to be able to meet the needs of the market at a low cost. And also to allow us to continue to grow by creep, just adding incremental production with limited cost impact.
Michael, thank you for your discussion today. Stuart Glazebrook from Glasgow Consultants. Just one question. In a carbon-constrained world and with as yet no magic recipe for the replacement of steel, what do you see as the role of aluminium playing in the construction industry going forward, and what also do you see as some of the opportunities for that metal in the broader construction context?
Well, certainly aluminium is being used as a substitute for a number of other metals, including copper in high transmission lines. It is being used a fair amount in construction, but steel is still the major supplier of material into the construction industry. But our material is lightweight, it's energy efficient, and it can be recycled. So you can recycle aluminium at a far lower cost, energy intensive, than you can steel or other metals. So I think the prognosis has to be good longer term as economies and industry looks to finding ways to reduce its carbon footprint. The difficulty we face, and which we need to continue to address, is to improve our carbon emissions in the production of both alumina and aluminium. That is a work in progress, and we need to continue to explore, develop new technologies. We use gas in Western Australia, so that's a big difference compared to oil. We've transitioned at least one of our other facilities in Spain from oil to gas, but I think we need to continue to look at ways to use solar energy, wind energies, other options, but that ultimately can deliver a firm source of power and reduce carbon emissions. Very important.
Mike, one last question from the back of the room there with Richard.
Hi, Mike. Mark Summers, Evans and Partners.
Hi, Mark.
How you doing? Mike, you mentioned the renegotiation of the AWAC joint venture in 2016 and how that benefited your shareholders. You also mentioned how your market cap is now greater than Alcoa's market cap. So my question is, if you controlled and managed the joint venture, are there other things that you could do to benefit your shareholders?
If I control the joint venture? Well, it's fair to say that Alcoa is financially constrained because it has, the AWAC interest is a good interest, but it has, probably up to a dozen downstream smelters, some functioning well and not so well. So they are capital constrained and they're very cautious around investment decisions. So it's fair to say that a while ago we initiated the process and the ideas about expanding Western Australia, and notwithstanding current market conditions, it will be a good opportunity to finish that work and make a decision, whereas they have other factors they need to take into account. I think if we were controlling the AWAC joint venture, we would focus purely on AWAC and the needs of AWAC, which will be reflected in the returns to our shareholders, as distinct from balancing between the needs of AWAC for Alcoa as operator and the needs of its downstream businesses and limitations in those businesses. It's probably the best way I can answer it, Mark.
We'll go to the thanks vote. Thanks now. Thanks, Mike. Thanks very much. That'd be a wonderful heading. I remember once in the past there was a headline that said Alcoa bids for WMC. Wouldn't that be a headline, that Alumina bids for Alcoa? You never know your luck in a big city. Members and guests, I'd like to call on Patrick Smith as the MD of AMC Consultants to propose a vote of thanks. Please welcome Patrick.
Thank you, Mike. As a former WMC employee, like many in the room today, I had some knowledge of Alumina, the business, and their successes, both from the merge time period and since demerger over the past 17 years. For example, I knew Alumina was low cost, first quartile business, well placed in the global market. The takeaway for me today, from today's presentation, is that Alumina is also first quartile environmentally, with industry-leading low CO2 emissions. Members and guests, please join me in thanking Mike Ferraro. Mike's doing very well. He has 2 gifts from Workwear. We have the usual rock hammer, and I believe a pair of work boots.
Thanks very much. Thanks, Mike. I'll put that there.